Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of what is an accidental American. This is a term that's thrown around a lot, especially in recent years with the introduction of FATCA, things like that. The typical situation we deal with here, lots of different situations, but one very common one, someone may have been born in the U.S., stayed here till they were 6 months, a year, 2 years, and then their parents went back to the U.K., Australia, Taiwan, etc., etc. And then now maybe they're 20 years old and thinking about going to college in the U.S., or maybe they're 35 years old working outside of the U.S. and they're going to be transferred to the U.S. and they want to apply for maybe an L1 visa, let's say. And after a little bit of research, they learn that they're actually considered a U.S. citizen. On the one hand, from an immigration perspective, that makes life a whole lot easier, but from a tax perspective, it can be brutal. With that said, most of the time it is easily fixable as long as the person qualifies for what's called the streamlined foreign offshore procedures. We'll go over that in a minute. So the reason why it's so overbearing for someone living outside of the U.S. is because they're not familiar with the U.S. tax system. Why would they be? They're living outside of the U.S. and they're firmly planted or rooted in whichever country they live in. They pay tax wherever they work, things of that nature. The U.S. is one of the two countries that follows the worldwide income and reporting model. So what that means is, even if you live outside of the U.S. and all of your earnings are sourced from outside of the U.S., in other words, nothing to do with U.S. income, if you're a U.S. citizen, legal permanent resident, or foreign national who meets the substantial presence test, then you're subject to U.S. tax on your worldwide income. So if you're living outside of the United States, you earn $100,000 worth of income, and now you've got taxes due in the U.S. There are ways around it. Normally you'll qualify for a foreign tax credit for any taxes you've paid outside of the U.S. And if you live outside of the U.S. most of the time, then you normally will receive most of the credit. It's not always dollar for dollar. You may also qualify for the foreign earned income exclusion and foreign housing exclusion. So once you get those items under control, it normally has no tax issue and no penalty on the taxes, but something that needs to be taken care of. Just as a side note, when it comes to the IRS and penalties, it's generally based on the amount of tax liability. So if you don't owe anything, you generally won't have any penalty associated. That is not the same for the reporting. When it comes to reporting, in addition to worldwide income, you have to report your worldwide assets, investments, and accounts. You've got bank accounts overseas. You may have an FBAR and a FATCA reporting requirement. You got foreign trust overseas. You may have a 3520 and 3520A. Foreign business, 5471 or 8865. A whole bunch of different numbers, a whole bunch of different confusing acronyms, but they are required. And even if you don't have a tax liability, you're generally still required to report the form. So let's say you have 30% ownership in a foreign business. Even if it's not U.S. owned, as a U.S. person with a 30% stake in a foreign company, you may have a 5471 reporting issue. Maybe this company pays you no money, zero income. Doesn't matter from a reporting perspective, and you can still be penalized even if you have no tax liability. And that's why there's such an uproar, understandably so, of course, for accidental Americans who learn about this. The FBAR penalties can be brutal. The FATCA, which is the Foreign Account Tax Compliance Act, those penalties can be brutal as well. We've got several presentations already on those types of issues, but one very important concept that a lot of attorneys who fearmonger and scaremonger don't like to explain to potential clients, is that oftentimes there's an easy way out. So the IRS has developed various amnesty programs. Some of these programs you might have heard of as voluntary disclosure, which is post-OVDP. There used to be something called OVDP for people who could not certify that they were non-willful. They kind of sort of knew they should have been doing something, is generally the standard. And then the streamlined program and reasonable cause and delinquency. Now, streamlined foreign is a very important program. It's called the Streamlined Foreign Offshore Procedures. What's so great about it is the following. You can go back and file 3 years of amended or original returns. You generally don't have to go back further than that. There is no penalty on the assets or accounts or investments that haven't been reported. So you read all these horrible websites and publications about 50% penalty on the max balance, or $126,000 and $10,000 per account per year. But if you qualify for Streamlined Foreign, all of those penalties are waived, and there is no penalties on the tax due, and you can apply things such as the foreign earned income exclusion, foreign housing exclusion, foreign tax credit. So your tax liability is zero and your penalties are zero. Even if you don't qualify for Streamlined Foreign, there's the Streamlined Domestic, which carries a 5% penalty, delinquency procedures, and reasonable cause. We have lots of free resources available on our website, goldinglawyers.com. You can always schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Have a nice upcoming weekend. Thank you.